I'm Keith McCullough, and welcome back. This is our last one. We started the Investing Summit, and again, thank you for all of you that have watched the whole thing. Listening to me rant certainly requires some patience, I understand that. But we had Mama Bear to start, we had Steph Pomboy, and we have probably the grisliest Canadian bear I'm going to find last to close it out. And I was just, David, and welcome, David Rosenberg, officially welcome to being our closer. We appreciate it.
Well, let's say, yeah, it's an honor to be back. I guess I always like to tell people, Keith, that I'm just a teddy bear.
Just a teddy bear.
I'm not gonna bite or claw.
Well, I was looking up. I just told you this, and you didn't read it yet because you said you hadn't looked yourself up. But yeah, I'm big into this Chat GPT thing because it saves me time, David. It's like we can look up kind of economic points in time very quickly. It saves me time. Actually, I was looking up when the oil price peaked in 08. I just asked it the question it told me. But so I look up David Rosenberg on ChatGPT. Who is this guy? So it says, David Rosenberg is a well-known Canadian economist who's known for his insights and analysis on global economic trends. He's been doing this for 30 years, et cetera, et cetera. It gives your resume. And then by the end of it, it says, throughout his career, Rosenberg has been known for his bearish outlook on the economy and has warned many risks, et cetera, et cetera. So that's a first of all, it's accurate. Second of all, like if I put in Jim Cramer, that would not be as complimentary. We have put in Jim Cramer. It's awful what the ChatGPT thinks. But you have had, like I know over the years you're not a perma bear, but you definitely, because you've been around longer than, first of all, most people haven't been bearish accurately on recessions as many times as you, because you've been doing it for the longest out of any of all of us. So you deserve that. I mean, I take that as a compliment, right? I mean, you've called every single recession in your career, correct?
Yeah, well, a lot of people say that I've called 20 of the past 6 recessions. So,
well, you got those. Sometimes, like 2016 was a tough one. It looked like we could have had one. I was right there with you, like bearish in 16. But it's what it is. It's better than the alternative. I mean, who in ChatGPT, if I put in, I don't know, Telecom Tom Lee or somebody, I mean, it'd be like he's well known for missing every recession in the history of recessions. I mean, and I know you just gave me a little insight that a famous economist or infamous economist, according to me, is like you offended him or whatever. But like, yeah. Shouldn't you be somewhat offended if your job is to be an economist and you miss 100% of recessions?
I think that you should probably go and find another profession if that's your track record.
That's the thing. I mean, it's like so. Let's get into this one. And I know you've written. You write every day, right? And that's what people love about you. You're in the game every single day. You've made, I believe, an analogy between 1929 as opposed to 08. I know every recession's different, but can you start with that? Like, how do you see this current one and how it's developing?
Right. Well, no. Well, if it's 1929, then we're really going to be heading for the hills. But it was more like 1989, and it was just more acknowledging, what happens in the aftermath of an aggressive Fed tightening cycle that inverts the yield curve, and then it's just a matter of waiting for when the financial event is going to happen, because whatever excesses there were during the Uber accommodation phase comes out of the wash eventually when the Fed pulls the rug and drains the liquidity. And so you never really know for sure what it's going to be. And this time around, of course, it's regional banks and it's commercial real estate. Maybe you can also argue, auto loans. And so all of a sudden we get, 3 banks in a row, Silicon Valley being the biggest and most important. And then all the king's horses and all the king's men, have to rescue Humpty again. And that's really what's happened here. Mm-hmm. And there's more chapters that are going to be written. So I only was talking about 1989 because, of course, everybody fights the last war. And all the questions I was getting is this going to be a repeat of 08 and 09? And my response was, well, lightning doesn't strike twice. And the big banks are well capitalized. We all know that, and much more heavily monitored and supervised and regulated than they were in the past. But it had all the makings of what happened with savings and loans back in the late 80s. And of course, that was commercial real estate too. And ultimately, a third of that industry ended up getting consolidated, and we created RTC. Had a classic three-quarter recession, had a credit crunch. The answer is no, the world didn't come to an end. But we had a three-quarter recession, we had a bear market, we had an elongated bull market in treasuries, and the Fed cut the funds rate from 9 7/8 down to 3%. So the flavor of this is, again, back to the small banks, which really, they're really not that small anymore. And while everybody is focused on, their unrealized losses and in treasury securities and deposit outflows forces them to sell these bonds at a loss and turn insolvent. Well, there's a lot more problems than just unrealized losses on treasuries on these balance sheets. And it's not residential mortgages this time, it's commercial real estate, which, by the way, in the overall banking system is now a $3 trillion asset on bank balance sheets. And if you go back to that last cycle in the late 80s, again, it was about commercial real estate, LBOs, very leveraged, overbuilt. So no two cycles are the same, but it seems more like that than, if I had to draw comparisons, in any cycle, that I've seen in my 40 years in the business.
Well, that's it triggers a lot of thoughts because it just triggers all the time series that we have looking back. And if you, what's interesting is that, like, the first couple things you hit on were yield curve inversions. And can we go there? I mean, we've had some talk about economists with infamous track records. I mean, we've had a lot of people, I'd actually say, including the Fed itself, say that an inverted yield curve is not a leading indicator. When you go back in 1981, it's most inverted since 1981, 10s, 2s, et cetera. 1989, we talk about much higher levels of interest rates, as opposed to the ones of the last 20 years. Can you talk about that why you're starting with inversion? Because I'm thinking that you think that that's a pretty consequential leading indicator.
Well, it's a signal from the bond market as to whether or not the extent to which the Fed has over tightened. So there's nothing really magical about it. It's no different than, you would say to me, why are you looking at down transports to utilities? Well, because you're looking at something that's cyclical divided by something that's defensive. Why would you look at the gold to copper ratio? Well, because these are relative price signals that have forward-leading characteristics for the economy. That's why you look at them. So the yield curve isn't the only thing that you should look at, and it's just a relative index. It's long-term rates relative to short-term rates, and it is a signal. And so I think that we should actually respect the fact that historically, only 15% of the time in the past is the yield curve inverted. I think that people just blindly talk about the yield curve. It's a very unusual development if you consider what every CFA student's going to learn, or MBA student, about the time value of money. Very unusual to have a situation, and especially one that's happened now for 9 months in a row since last summer, where the level of short-term interest rates is higher than the level of long-term interest rates. It's not normal. It only happens 15% of the time in the past. And it's the bond market's way of screaming, "Uncle, Mr. and Mrs. Federal Reserve, you've gone too far." And what I find very interesting in this business that we're in, Keith, is that it is populated with optimists and bulls, because you can be bullish and wrong, and you'll have your job to perpetuity. Everybody will forgive you. And the reality is that, like I said before, the yield curve is only inverted 15% of the time in the past. And that 15%, so what's that, like 1 in 7 event? I think that you and I would both want to pay attention to a 1 in 7 event. Recessions happen 15% of the time. Expansions 85% of the time. But we want to get the business cycle right. And by the way, bear markets happen 15% of the time. So the stars are aligned. And it just so happens that the stock market is a leading indicator. All the ratios you would look at, you'd want to look at consumer cyclicals to consumer staples. You'd want to look at small cap versus large cap. You want to take a look at, in the FX market, you'd be looking at, Swiss franc, versus the Australian dollar. You're always trying to see what are these relative pricing telling us about the economy, because these are leading indicators for economic activity. The yield curve only has given us one head fake in the past. I guess there's always a way you can dream up why we should ignore the yield curve. The only time the yield curve, going back in the post-World War II experience, the only time it gave us a head fake when it inverted and we didn't get a recession was back in the summer of 1998 when the Fed wasn't tightening. We just, because of long-term capital and the Asian crisis, the final legs of the Asian crisis, we had a massive flight to quality. And the long bond yield and the 10-year went slicing through the Fed funds rate. So the curve inverted. The Fed wasn't tightening policy that year, but we rallied into the inversion in the Treasury market, and then the Fed ended up cutting interest rates right away. But that's the only head fake that we've ever had. So I'm not really one to fight history, especially one with such an impeccable track record. It's funny that I see the economists and I even see Fed officials with a spotty track record, and I'm not going to be that person that throws stones from a glass house. But the yield curve does not really have a spotty track record. It's just a matter of there's a wide dispersion on the lead time to the recession. But the one thing I'll say is, it's funny that if you and I are sitting here in, say, the spring, summer of 2009. Or you and I are sitting here, say, in the summer and fall of 2003. Or if you and I are sitting here in the summer of 2020, and the Fed has cut rates aggressively. And of course, when the Fed's cutting rates aggressively, the mantra is don't fight the Fed. Do you hear that today? But when the yield curve is steep and steepening, which is a signal for a long runway for growth, everybody and their mother is talking about the yield curve. Only when the Fed's tightening it inverts are we told, no, it's a relic from the past. I'll tell you right now, all these people saying ignore the yield curve today, this is my forecast. When the Fed cuts rates and re-steepens the yield curve, they'll come out of the woodwork telling you, look at the yield curve. What more is there to say? But it's the bond market's way of telling the Fed, you've overdone it. And this Fed doesn't seem to care, because once burned, twice shy. From transitory to 9% inflation last June, and they just said enough is enough. So they're quite prepared to have the economy as a sacrificial lamb to drill a hole in inflation once and for good. And I think they'll end up getting more than they bargained for.
Well, it's a very good rehashing of history, and I'm glad that you didn't get interrupted by a commercial or some talking head while you gave people that lesson in economic history and risk management. I mean, like, why would you ignore a 1 in 7 chance, or why would you ignore? I mean, once you layer on all the the conditional factoring, which are the market signals, and it's interesting, isn't it, for everyone who's watched this whole thing? Stephanie Pomboy also citing gold to copper. I mean, these things are collectively, you have to look at the entirety of the thing, and only experienced people that have accurate experience in seeing it should really be held with any credibility at all. I mean, obviously that's not the industry that we're in, but one thing I wanted to tie back to, because you mentioned it, 1989 going into the 1990-91 recession, and savings and loan crisis, and the not the similarities, but obviously the trigger to these regional banks. Now, guys, if you go to slide 52, we're showing the senior loan officer survey, which is the Fed's about to get the most recent one. We don't need to debate what that update's going to be. It's pretty clear it's going to be horribly bad. But how about this time? If you go to the beginning of that on the chart on the left side, I don't know if you can see it, David, but this would be probably emblazoned in your head anyway, or is. When you look at the CNI lending cycle and you look at the beginning of that chart, that's actually an extremely important point. If it's more like 1989, I mean, it took a while to work through that on the CNI side. CNI, of course, if you kick out the next two charts on slide 53, is a great leading indicator for a spike in jobless claims and, of course, a collapse in CapEx. What do you think about that? I mean, this time, I could make an argument that the CNI is going to be the worst that it's ever been, just given the dislocation and concentration to 4 banks, but the dislocation of the credit line everywhere else.
Right. Well, what's interesting is that, when you look at that quarterly survey by the Fed, which came out a couple of months ago for the first quarter, it was C&I loans, it was commercial real estate, it was consumer loans.
Right.
It was very broadly based. And we already knew that the banks, what's interesting is that before Silicon Valley Bank, that the banks were in aggregate already tightening their credit guidelines, as you correctly said, and that's a diffusion index, and it is a great leading indicator. They were already tightening, and we know from the previous reporting cycle 3 months ago that the banks were already embarking, even before this latest financial imbroglio. We won't call it a crisis, we'll call it something else. That they were already seeing impairment on debt service and rising loan delinquencies, albeit from a low level. But you're always starting the end of a credit cycle from a low level when it comes to delinquencies and defaults. I actually had noticed that people were saying to me, well, default rates are very low. But I was showing my clients charts where the 1 month late payment rate, which is the feeder for default rates down the road past 90 days due, that was starting to hook up discernibly across almost every line of business in the banks. So the banks had already been raising the loan loss provisioning reserves. That is obviously going to be continuing. And the Fed loan officer survey that you showed, contained, the first quarter, and a lot of the action really started post Silicon Valley, in the last several weeks of March. The March data points, it's interesting that, when you go to the New York Fed in their consumer expectations survey that comes out every month, the number for the month of March, and this is for the consumer, and this is on the index on access to credit. And access to credit for the household sector, the most onerous on record, and the data go back to 2013. And John Williams heads up the New York Fed, and just watch him vote for a rate hike on May the 3rd. It's rather incredible. The NFIB small business survey, so we got that number over a week ago, again for March, and the share of small businesses saying that credit is tougher to access is back to where it was in early 2020, when the economy was shuttered because of the pandemic and the lockdown. So those are just the March numbers, and you're quite right. The ball's just getting rolling here on the credit crunch. That was ubiquitous in the Fed's Facebook yesterday. Every region outside of Minneapolis, and I guess with farm incomes doing what they're doing, I guess the Minneapolis Fed doesn't have to worry about defaults or credit crunch. But all the other district banks, all the other 11, contained some pretty nasty references related to financial conditions tightening and credit constraints. And this is an economy that's driven by credit. Mm-hmm. And this is just starting. So I think your point is very well taken. There was a fellow, I don't know if you ever met him or knew who he was. He was probably the number 3 guy at the Bank of Canada back in the 80s and 90s, back when John Crow was running the show, and his name was Chuck Friedman. And I don't know if you ever met Chuck.
Nope.
Long since retired, but he was really a venerable, very well respected central banker in Canada. And I remember having lunch with him many moons ago, where I actually asked him, what is the Bank of Canada's favorite leading indicator for the economy? And he said, the senior Fed loan officer survey out of the US. And I said, oh, very interesting. So it's interesting that you have that chart up. Of course, everybody's talking about it right now. So answer is this. You know what? If you don't like the yield curve, you don't want to look at the yield curve, you want to bury the yield curve, there's a lot of other indicators out there that are basically painting the very same picture.
Well, if I just let this guy talk, he's going to fit in the ChatGPT description perfectly, because it's like, so I could almost, you rattle off 8 different points, and there's a time series for every point that he makes. Guys, go to slide 75. Small businesses. This is this, like again, what he said, that's the picture of it. It's the lowest level of optimism since the great financial crisis, and it went there very quickly. That is way worse than going into 1990, 91, 92. And there's so many different components to this. The asymmetry, indeed, I think is probably the most, when you say that this is an economy that's hooked on leverage, it's not just that, David. I mean, it's the people that we talk to. It's the people that pay us. I mean, what Jonathan Gray said today at Blackstone is shameful. I mean, in terms of painting the picture that he wanted to paint, of course, but that business doesn't run at this interest rate with this level or lack thereof on liquidity. It just doesn't. So we have these monster credit bubbles, and I have institutional clients that will say to me, say back, hey, I hear you on commercial real estate. It's just a casual 1.4 trillion in maturities coming due in the next 2 years. They won't say that part, but they'll say, hey, I hear you, but that's kind of isolated to commercial real estate. I mean, like really? Or say things like you just said, which is, well, when we look at default rates looking backwards. I mean, I still, what do you think about that? I mean, we have to be careful because we're talking about buy-side clients and accounts. We're not naming those names for sure, because that's how you and I get fired. But but we do have to answer these questions in a professional way without saying, are you out of your mind? Like, I mean, like slide 78 shows commercial real estate charge-offs in context. They were at 3 basis points. 3. No shit, they look controlled looking backwards. Without the secular issues can go to 250, 300 over in a New York minute. I mean, how do you, first of all, have you been told that? Like, what do you hear back? Do you hear that on commercial real estate? Does that come back at you as like it's been ring fenced or it's its own issue?
I think that it's more the pushback is that it's not a big enough problem to generate the conditions for an overall recession. And that's when I have to get in the weeds and show them that that commercial real estate today is actually the biggest asset on bank balance sheets. It's bigger than mortgages. It's bigger than consumer loans. It's bigger than even C&I loans.
Yeah.
And so I say, well, look, vacancy rate nationwide's gone up to over 18%. You're seeing rental rates come down, and you're seeing prices deflate. This is a $3 trillion asset class that's deflating, and it's not the same, admittedly, as subprime mortgages. People always think that, you and I are trying to compare to the last war. All I can really say with certainty, and what's amazing is that after the Fed meeting in March, Powell talked a lot about credit conditions tightening, and they just don't know how much and for how long. But that's what we're going to come out of this, because banks now are going to be focused much more intensively on their balance sheets, and it means they're going to be curtailing credit to everybody outside of the most creditworthy borrowers, and that at the margin, because economic change is always at the margin, is going to have an impact on the economy. And we were heading into recession in any event. And unless you believe that the business cycle's been repealed and interest rates don't matter, interest rates always matter, and it's not the level, it's the change. I had this back at Merrill, back in 2007 when everybody was telling me, well, the funds rate's only 5.25%. I could say, dude. Well, I was trying to be polite, so I didn't say dude. I said, it's the change. We went from 1% at the 2004 lows to the 06 highs to 5.25. It's the change. It's the change. Because when you're modeling the economy, you're doing change on change. You don't do change on level or level on change. There's no econometrician in the world that would ever model change on. It's a change in rates, and we just lumped in with a 3-year rate cycle into like 1 year, and it's going to have an impact not just on commercial real estate. That's the canary in the coal mine. And this is where it comes back, by the way, to the regional banks, because that is their high degree of concentration. It's not in treasuries. Commercial real estate is the lion's share of their asset base, and that's where we're going to be seeing a lot of the problems. And the one thing we know about Fed tightening cycles, into recessions, the impact it has on the supply of credit is that it's a domino game. So it's not as if residential real estate's not going to be affected, or credit card debt, or autos, because these are the arteries that run through the financial system and the economy. Everything is correlated with each other. So it's just like, I mean, I guess we could talk about, what happened in the spring of '07. It was New Century Financial closes its doors and everybody's whistling past the graveyard without connecting the dots as to what knock-on effects are going to be down the road. Then we get to Countrywide, we get to Bear Stearns, we get to Mother Merrill and AIG, and a lot of other stuff happened along the way. This is early stages of a classic credit crunch. And all that's unknown is the magnitude and the duration. And we have a Fed that is so anally retentive on the most backward-looking indicator of all, called inflation, that they're still raising rates into this, which is virtually unprecedented. Volcker did raise rates into continental Illinois briefly in 1984, and then within 6 months, he's slicing rates 150 basis points. I'd say that you're 100% correct. Commercial real estate, C&I loans, I think there's going to be a broadly based contraction in credit coming that's going to be very deflationary. And that's what I think. So when people talk to me about this, I'm trying to tell them that, this is the time when you actually want to speak to the economic historians, because although no two cycles are the same, and Mark Twain was right that, they don't repeat, but they rhyme. The reality is that patterns do reemerge.
Mm-hmm. I mean, if it's there's another chart that again he can tell you guys. Slide 51, the vacancy rate chart. Now the thing with the rhythm and the rhymes, the patterns, they do repeat, but then you get into moments, of it's classic like thermodynamics. You have your energy, which was the easy money. And then you get your entropy. So the change on change changes, and if it changes in the weakest spot, whammo. Like that chart, David, has never done that. And it's the inverse of the leverage, right? So that to me is probably the most, I don't know if it's alarming or, if it's disgusting or it's just disappointing or what it is, but I mean, it's almost like our profession doesn't exist. I don't know. It's perplexing to see these points of entropy that are the inverse of the energy that was provided by the easy money to be ice. Oh, that one's just this, or this one's just that. It's crazy. I mean, I don't get it. Change on change, rate of change. Obviously, that's all we do. So maybe it's just that we talk a different language. And it is an interesting thing. I mean, I don't know if I've ever told you this, but we bought when we bought Potomac Research. It was interesting experience. Let's just say that. Research. I build my own thing and then start trying to buy other ones. I'm not going to get into what it was, but what I got in that was Don Cohn. So he's the vice chair of the Fed. You can imagine, like, if there was a marriage made in Canada, it wouldn't be Keith McCullough and Don Cohn, right? But he was a nice guy, good, like a lot of people. I mean, they're nice. I just wouldn't have like my buddy Luch in Thunder Bay, Ontario, modeling the economy. But what the number one takeaway I had, and a very healthy respect for it, was that Don Cohn said, Keith, I hear you, but it's not, the Fed doesn't do RO's rate of change, they do levels. And I was like, huh. Then I accepted it. We're kind of fucked, because you have the institution that matters making the decisions, the authority, is using the wrong process, or in Canada we'd say process. They're just using the wrong models.
Well, I guess that's why, since 1950, we've had 14 Fed tightening cycles, always with good intentions, and they landed the economy in recession 11 of those 14 times. And the other other things were going on, external positive shocks, like LBJ's guns and butter fiscal policy, or in the mid-'80s, OPEC pumping oil like it was nobody's business, had a 70% collapse in oil prices. It was like a tax cut. And then the mid-90s, Netscape going public and ushering the internet craze. But the Fed, I think that you're 100% right. But I'll tell you that for the here and now, Keith, what's really interesting is there is a war going on between the Fed staff and the FOMC. And I fell off my chair when I saw in the last set of FOMC minutes from March 22nd that the Fed staff is saying recession starting this year. Now they call it a mild recession. Mild recession is not a soft landing. We had a mild recession in 2001. Well, for investors, that was no walk through the park. And the Fed staff said that they expect headline and core inflation to get to 2% by 2024, which is a year away. And I'm thinking that's interesting. I think it's for the first time ever. My forecast, the Fed economists, the staff were calling for recession in September of 2008. But they're calling for recession, and the Fed's tightening into that. And I just find that, if you're going to ask me what is the most fascinating thing going on right now, it is the battle royale between the Fed economic staff and the FOMC. So I know what you're saying. I think that, look, they obviously spend a ton of money on their macro econometric models. Look, they're doing their best. I mean, look, they're academic PhD economists, but they're not idiots.
No.
But the thing is that these people on the FOMC, people like Jim Bullard, what's his model? And when you're on TV and radio so much, how can you even spend time on your model when the cameras are rolling? But the Fed staff does have a model, for better or for worse. The FOMC, the spokesman voters on the FOMC, raising rates into a recession with inflation already falling, understanding that it's very glacial. I mean, inflation is not Bitcoin. It's not the CRB index. For economists, it's a very fascinating race between watching paint dry and grass grow. And you got these guys. I know what the Fed is looking at. I know what they're looking at. They're looking at a range of contemporaneous and lagging indicators to an extent I've never seen before. So we can go back and compare this Fed to all the other flawed Feds, whether it's Greenspan or Bernanke or Yellen. I don't think I've ever seen anything like this. And they publish in the minutes. And this is what they want us to know. The minutes are just polished, scrubbed. They have to vote on the minutes. Oh, they voted on the minutes. Well, we'll vote to tell the public, to confuse them even more, that the Fed staff's calling for recession. Oh, but we'll continue to raise rates. Interesting dynamic.
It's got a batting average of 100. I call it quad 4, when the rate of change of growth and inflation are slowing at the same time, and the Fed's raising rates into it. He did it actually and it was from a positive rate of change in Q4 of 2018 when Powell was a rookie, as the head of the Fed, and S&P was down 20% in a New York minute, and he turntailed dovish. This time he's not. So that's a very, very important point that you make there. I want to just get to, and if you have questions for David, just pop them in the queue, and I'll ask them if they're good. Because I have some more good questions for David. On the latest of late cycle indicators, which is labor, how do you think the movie goes? I hear a lot of opinions, just like to your point, Neil Kashkari or whatever his name is in Bullard. I mean, these guys don't, like Kashkari's had like 10 jobs in 8 years. I mean, these guys don't have a model. Like, we have a sophisticated nowcasting model that's built using Bayesian principles with a stochastic overlay. I watch all 30 factors go into it every single month, and with industrial production growth going from 2 to 0.3%, I know what that is, right? So I don't really need their opinions. But there are a lot of opinions on labor and how it's different this time. The C&I loan survey that I just showed you has been historically a very good leading indicator for not only an upward sloping rate of change in jobless claims, which we already have, but a spike, like the old adage, risk happens slowly and then all at once. So how do you foresee the next 3 to 6 months, or entering any recession for that matter? Never mind this one. On the labor side.
Well, I mean, there's a lot of peels on the onion that we got to take off here. So the first is that these payroll numbers are going to get revised in the future, and significantly. So it could well be that what we think is just these ripping 200,000 plus numbers, they weren't actually that strong. You've got to remember, Keith, that the response rates to the BLS data across the board is substantially lower than it was pre-COVID. The response rates and therefore the reliability of the data is a lot lower. Nobody talks about that. On top of that, employment. In over half the cycles back to 1950, employment is still rising into the early months of the recession.
Right.
So it's a coincident to lagging indicator. It tells you nothing about the future. And the unemployment rate is just like, great chart before. The default rate peaks after the recession is already over, just like the unemployment rate peaks 3 months after the recession is over, and it bottoms 3 months into the recession. So you're watching the unemployment rate and you're saying, where's the recession? And then in the early months of the recovery, it's still going up and you're saying, where's the recovery? So it's basically just a useless statistic unless you want to use it as a contra-cyclical indicator. Though we're looking at jobless claims numbers, they're hooking up. Continuing claims, they're hooking up. Look at the challenger numbers. The challenger numbers on hirings, way down, and on layoffs, way up, and really just broadly based right across the board. And that includes leisure and hospitality, which has been the last man standing, in the employment data. Really the reopening cyclical segments of employment that only recently managed to make it to a new high. That gap has been closed. You see, most of the job gains have been in hospitality, leisure, education, and healthcare. And these areas lag behind in the early stages and mid stages of the reopening because ongoing fears because of COVID. But the only sector in the services side that hasn't closed the gap with the pre-COVID high is hotels and motels. And they're still down 238,000, but that's it. So what happened in the last employment number was very interesting, was goods producing employment was down 7,000. Goods producing employment's coming down at the same time that services are still going up. And this is classic. You talked about late cycle. We just saw a critical divergence. I think that's what makes you and I'm not going to say different. It's what makes you and I unique, is you and I, whether it's the markets or the economy, always looking for divergences. Big divergence now between goods producing and services, but don't you see services ultimately service the bottom of the pyramid of the economy, which is called the goods producers, the people that make stuff. And so that's classic late cycle when you get this divergence. On top of that, best leading indicator for employment, which is actually in the Conference Board's leading economic indicator, which came out today for March and was down 1.2%, now down 12 months in a row. That is as much as the yield curve, that's a bona fide recession indicator. But the work week, like I'm trying to tell people, it's like in that scene with John Candy and Steve Martin when they're driving on the highway and the couple who thinks they're going to get killed yells out, "You're going the wrong way." So I'm trying to tell people, you're looking the wrong way. You're looking at the headline non-farm payroll numbers, but labor market is a very complex beast, and you can't look at it just with bodies. You have to take a look at it also with respect to the hours that the bodies are putting in. And we've had so what's happened is that the work week is contracting. That is a phenomenal leading. Like I say, Keith, I'll just say, you don't like the yield curve. I get it. When it steepens, you're going to love it. But right now, you don't like it. I get it. But the work week,
You're going to love it.
The work week's been contracting for the past year, but the past 2 months, it's been declining. And the decline in the work week has actually swamped the headline non-farm payroll gains. So when you look at the data holistically, and you look at what's called the index of aggregate hours worked, which is total labor input into the economy, it's been negative 0.1 2 months in a row. People say, "Oh, negative 0.1, big deal." Yeah, in 150 million workforce, That is a big deal. It means that actually, in each of the past 2 months, payrolls, when you adjust it for hours worked, have been negative 140,000. Capiche paisano. It's actually, if you weigh in the hours, the labor force is contracting. And the one thing we know about history, yet again, is that companies cut hours work first, they cut the bodies next. So I'd say in the next 3 months, expect non-farm payrolls to start to contract, and I frankly think that is exactly what the Fed is waiting for.
Yeah, this is one of the, man, you're nailing every frickin' point. I mean, which is don't drive the wrong way. That's a good one. Guys, show slide 47. I mean, that average work week chart, I mean, we're saying the same thing. This thing isn't down. I mean, even if the 0.1 doesn't tickle your fancy, I mean, that thing is absolutely collapsing. There's rate of change slowdowns, David, and then there's that. I mean, that is a disaster. Take that, that's the inverse of vacancy rates. I mean, we're seeing the fastest sell. This did not happen this way. Well, actually, it's never happened this way from the cycle peak. I mean, obviously, it's going right to where that was in '08, but it's coming from a much higher level. That's my main problem, like when I'm trying to there's only so many ways you can communicate the same thing. I mean, it's like, okay, McFly, now you want to drive the wrong way and buy the 6 or 8 or 7 stocks because the S&P is going to compromise your ability to breathe or live because you can't look at that and live with that. I mean, it's just like, can you address that part? That's the last big one that I wanted to hit. I mean, this stock market obviously is not a market of stocks. It's a concentration of well-known exposures. Can you talk about like how you try to answer that one?
Well, it's a if you looked at the cap weighted and equal weighted S&P 500, you're looking at two different charts,
right?
And so you've had basically 8 stocks carry the load this year. So it's a very, as you said, highly concentrated index, and become more so in this year's action. So yeah, I would say that it's a dangerous market right now, and there's a tremendous amount of complacency. The VIX at 17. You can't ignore valuations. It's not a timing device, but we're at a 19 multiple on forward earnings. 19 multiple. Like what? Here we are, 15, 16 months into what's been a fundamental bear market, and the multiple's at 19. The forward multiple's at 19 for the S&P 500. And when you're taking a look again at history, because history is a guide, the average and median pre-recession, pre-bear market bubble peak is 18. We're at 19. The multiple right now in the stock market is higher than it was at the bubble peak in October of '07. So how much more work do we have to do? So I think that, you're 100% right. It's a very concentrated index, very overvalued at this point, because everybody seems to be talking about a soft landing. Everybody thinks that, there's still all this excess savings, that the consumer's flush with cash, balance sheets are in great shape. I mean, it's all look, I've been doing this for so long, and I know all the signs and all the rhetoric and narrative on bubble vision, and it's borderline hilarious, So I would say that that's the mantra right now. The mantra right now is that if you believe in a soft landing, buy the market. In fact, I would say even if you believe in a soft landing right now, a 19 multiple is egregious. Look, what's that? That's a 5.3% earnings yield. I'd rather go buy a crossover, single A, triple B at 5.4% and just line up in a better part of the capital structure.
And if you're so hung up on year-to-date return, then why aren't you long gold? It's up 10. I mean, it's not up. If all that matters is the SPY's return, I mean, it's ridiculous. I guess this is my last question on this. Then, I mean, when you any chart that I look at, whether you're coming from the bottom of the chart on vacancy rates, which is obviously when the economy was at 12% year over year GDP. That was 12. That's obviously the highest number since you and I have both been alive. To the highest level of the work week chart. I mean, that chart is at the highest level ever it came from. The earnings, and by the way, that was a March number, okay? Tesla today reported their March numbers. It's like they told the street that they cut prices 3 times before they had to say, McFly, that hasn't done this before. I know you like your crypto thing and your Tesla thing, but it's like we're coming, and that's my question. Like slide 60, the asymmetry of the thing that you just identified, which is a summary of all the things in the bubble, which is the cash flows and/or earnings that backstopped it, is coming off the highest level ever and from the fastest rate of change to get to the highest level ever, because in prior cycle tops you had the highest level ever. So this, why wouldn't this, like the black line, next 12 months of earnings, why wouldn't it start to look like anything else that we have, March data on? I mean, why isn't this, like, why is there even, it's not even a hilarious debate. It's like it is hilarious, to your point, like Stephanie Pomboy and I, like Mama Bear and I were laughing half of our discussion, but you're not like the laughing type guy. I mean, I'm not laughing right now. I mean, but it is laughable. Why isn't the multiple, why can't this thing go, in the 1970s that went to 8 times. I mean, and not from that level. I mean, I guess the ultimate question is is David Rosenberg, am I, first of all, and is David Rosenberg bearish enough? I mean, why even entertain that 19 off that level?
Well, I think that, the 70s, that's right. I mean, I always tell people that we have a central bank chairman named Jay Powell who fancies himself the modern day Paul Volcker. And when I tell people, well, the Volcker put was 8. In the summer of 1982, so be careful what you wish for. But
you mean the S&P 500 earnings multiple? Yeah.
Well, so I guess that different inflation environment, different interest rate environment, different. I mean, real rates were a lot higher, so I don't think we're going to get there. But let's narrow it into, say, the past 20 years and get off the stagflation. I mean, the economy is so much different today than it was back then. It's not, like I say, there's no new eras, and excesses are never permanent. And our future is not one of inflation. And yes, COVID's changed a lot of things. The financial crisis coming out of the Great Recession changed things. The dot-com bubble changed. There's always changes that are taken. The economy is always changing. I hear this. Well, this shock changed things. Well, I don't believe in the big inflationary future. So you have big inflation. The multiple or the fair value multiple is inversely correlated. I don't have a big inflation call. I have more of a generalized, elongated period of uncertainty, of economic weakness, and my sense is that the multiple, which is really the pulse of investor confidence, is going to be more likely from this level to be lower, not higher. And when I looked historically, because I put my history hat on, because it's helped me over time, you don't even have to go to 8. Maybe we'll get there, but I'm saying that I'm thinking a 16, 15, 16 multiple is a classic multiple trough in the modern day. Mm-hmm. And then you got earnings, because at any moment in time, what's the S&P 500? It's a price. It's earnings times the multiple. And classic plain vanilla recession, let's hope that's all we get. The Fed staff's telling you mild recession. Mild recession equals 20% reduction in EPS. So you do the math on that, and it's not the end of the world, but it's like close to 3,000 on the S&P. Mm-hmm. And I can't tell you, because I'm not that good, that I can tell you what week, month, quarter it's going to happen. I just know the destination. I know the point at which, unless other things change, that I will morph from the Canadian perma bear to the perma bull. and I'm eagerly awaiting that moment. But that's what falls out. It's just, people's estimate of the S&P. It's just math. Where's your multiple? Where's your earnings? We're
Yep.
going into a recession, and I'd have to say that it is not fully appreciated, not remotely priced in to any asset class, no asset class. And when the Fed's now going to be later than it ever has been in the past, and they will be, and this Powell Fed pivots like it's nobody's business. They'll be cutting rates in the next 12 to 18 months like it's nobody's business. I'll tell you right now, I think that they may well go back to the zero bound.
Wow. Well, I'll be happy with my long gold and long duration position that I've been building
the bond bullion barbell.
Well, that's
level of direction, and that's done well for you this year.
That chart that I just showed, by the way. I mean, this Thunder Bay bear and the Toronto Grizzly bear. When that rate of change chart bottomed, that's earnings, the black line, in 2009 in the first quarter, I turned into a bull. Yeah, I'm in no rush to go there until we get there. That's the thing about bears. I believe we're a non-herding species, I suppose, David. So, and I think Canadian bears are a little tougher than some other kinds of bears. You got to be a little tough in times like this. You got to take the shots. Like you got to take the tweets. We just got to deal. Let's let it play out.
Because we have to hibernate longer because of the horrible weather, and we're just in nastier moods because no Canadian team has won the Stanley Cup since 1993. So we're just bears in a perennially bad mood.
And you're correct me if I'm wrong. I think I've asked you this. You're a Canadians fan, not a Leafs fan?
Yeah, but Keith, do you want me to put a paper bag over my head now? As a fanatical Habs fan in the 70s, I never thought I'd actually say that, but yeah.
My good friend, a very good friend of mine from Connecticut, but he's from Quebec. Martin St. Louis is now the head coach. So I think that, and knowing him and knowing how committed he is, and he's such a grinder and such a man of integrity and a guy who can speak both languages. Obviously, I think that. I'm no Canadians fan, but I kind of am a little bit secretly now, and I just revealed that secret. But I think maybe after the Leafs, down 3-0, after all these signings, after the first period at home, I mean, I was my own kid, all of my kids are now old enough, all 4 of them are old enough to come. I didn't need a paper bag, they're just mocking me. It's just oh my God. Meanwhile, the team that they like, because we live here, the Rangers, they're pounding the Devils at home on the same night, and they're like, "Dad, why are you in there just lamenting over the Leafs?" I'm like, eventually I went out there and watched the Rangers because they won 5-1.
Well, I got news for you, my good friend, that if the Leafs do win the Cup this year, and they won't if they play like they play tonight like they did on Tuesday, but if they win the Cup, I have to leave Toronto for 3 weeks.
Oh, that's a long, talk about long-term cycles. 1967, man. That's a bear market. That's a deep.
That's a secular bear.
That's a secular bear. So we'll end on that. 2 bears, for now, and 2 Canadian bears. We're both proud Canadians, and thank you for being just professorial, surgical, data-driven. Everybody loves that about you. So ChatGPT has it right.
Thanks, Keith. Thanks for inviting me back on. It was what can I say? We must have had fun because the arrow went by like the snap of a finger. So thanks for having me back on. It was a pleasure.
Yeah, good to chat with you. Thanks, man. See, that's the end of it, but it's really the beginning of it. It's the beginning of the end. And I'm not trying to be some Sith Lord or dark person here. The whole point of why we started Hedgeye is to make sure that we preserve and protect your hard-earned capital. That's it. There are periods in cycle time where you can just buy whatever you want. Again, quad 2, we call that. And again, we came out of one of the most ebullient periods in world history, okay? So just understand that this is our goal, this is our mission, this is who we are. We brought in a bunch of people to help reinforce that so that when you're at your weakest point, I mean emotionally, and admit it. If you have money in this, you will go on emotional tilt. You will have some FOMO. We want to get you back to the place where you can be indifferent about your emotions and stay with the data, stay with the cycle, know that you don't have to be early, all right? You just need to have this level of macro awareness and a process and the types of people that'll keep you up to speed on it, because all the data is changing every single day. And we're going to change alongside it, and we appreciate that you spent your time with us in the last 3 days. Thanks for joining us.